Hello traders, just wanted to take a minute and share with you something that I noticed. Now I was on vacation this week, so I didn't trade all but just a little bit on Friday, but I did pick up something that I thought was pretty interesting that occurred this week on the pound yen. Now we're looking currently at the 4-hour chart as you see here, and what happened this week was that the pair just really stayed in a consolidation. We had a low that was on the 30th of July of 134.18, and on August 3rd we had a high of 137.75 or 76 area. And so those were our range that we were in, and then as you'll see, especially when we look at the 1-hour chart, that the pair just continued to consolidate with inside this move that was seen from this high and low of the July 30th to the August 3rd. Now, when you draw this Fibonacci level and look at the levels that are seen here, we see the 382 level, the 50 level, which is hidden behind some of these candles, and then the 61.8% pullback of that upward trend. There was some very interesting entries that came along this week that I thought would be worth considering. Now what you'll notice here is that I have a few arrows drawn at some entry points based on these Fibonacci levels. Now again, because it's a pound yen, I think I have a pretty strong view about the fact that a 20 pip stop is not quite enough. This pair tends to have some wild wicks, and so I prefer personally a 30 pip stop for this pair. But let's just do a little bit of an exercise here and see what could have happened this week, starting with this first entry on August 4th. Back at the 50% drawback level, which was 135.97. Now when this first candle hit here, we see that if we would have entered at 135.97, we actually had a low of 135.85. Obviously our 30 pip stop would have been just fine. And then what we'll notice with this one blue candle is we actually got to a high of 136.44, just over a 1-to-1 ratio return. So if you at a 1-to-1 ratio would have moved break even and then maybe taken half off, you would have seen that would have been a very positive trade. The second time it came back down to the 50 level, if we would have again entered at 135.97, you'll see that we had a low here, 135.83. Again, our stop being at 67 would have definitely been safe, and this trade actually paid out quite well as it got to a high of 137.47 or 150 pips. Now, personally, we can manage that trade however we see fit, whether that's taking half off at 1-to-1 ratio, moving our stop to break even, or just really watching it more with a trailing stop. But obviously that trade would have paid very well. The next opportunity is when it again came back to the 50 level. If you'll notice on this candle, though you can't see it on your screen, the low was 135.76. So a stop of 67 should have been safe unless you had a real wide broker spread for that one. But that one should have been a safe entry also. And then you'll see that the high of this entry gave us about a 90 pip play on this one as we got up to 137.04. So again, a very nice entry. Now if we would have tried to bounce this 50 level a fourth time, which probably would have been pushing our luck, but if we would have, we would have seen, we see here, we would have had a failure. We would have had a 30 pip loss. But what happens is the candle comes down to the next level, which is the 618, and gives us a very valid entry at this point. Again, at 135.54, if we would have had a 30 pip stop, our stop would have been at 24. Well, the low of this candle was only 45, 135.45. Obviously, the 30 pip stop would have been very safe. And then this trade got all the way up to a 92, which would have been a very nice trade going from, excuse me, not 92, pardon me, 39. So from 135.55 basically up to 136.40. So again, a trade that would have given you about 75 pips roughly. So it's very interesting to see. Here we have 5 trades listed. One of them was a for sure failure with a 30 pip loss, and yet it's obvious to see that these other 4 trades would have paid out in spades in comparison to the one loss that we had. This was in a week when the pair was really in consolidation, so it shows you that trading these Fibonacci levels can be very productive. You could trade them with pending orders based on these levels, and obviously the opportunities would have been very good. Now, one thing to keep in mind too that I watch for is the fact that I have two trend lines drawn here. The blue one is the 50 moving average, and then the black one that I have here is the 100 moving average. I don't really trade off of these as some people do, but what they tell me when you look at these two lines is basically they're horizontal, which is telling you that the pair is in consolidation. It's not trending. And so where that can really help you is that it can give you a recognition that you may not want to try to hold on to these for some extended play of 2, 3, 400 pips, because really what you're seeing here is that it's telling you the market is in consolidation until you really get a trend move. So it can be something that can be helpful to you. The other thing to keep in mind, this type of setup that I'm showing you here, these are not for someone that's short-term trading. For instance, this trade that we have listed right here, if you would have entered at this level when it struck here, you're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16-hour trade. So that's not for every personality, obviously. Now this first one was about 4 hours. This one here, we got at least a dozen hours involved in this one, and then this one here, we've got about 6 to 7 hours involved in it. So these are trades that are a little more longer term, more swing trades, but I think they show clearly that they are pretty effective. Hope this information helps you. Good trading.